Hello, my name is Miles Kellerman, and today I'll be presenting my recent article in Regulation and Governance. The title of this article is Market Structure and Disempowering Regulatory Intermediaries, Insights from U.S. Trade Surveillance. So this article is inspired by a particular policy problem, and that's detecting market abuse. This refers to insider trading and market manipulation. These are forms of economic crime that are prevalent in virtually all capital markets, ranging from equities to FX, to newer markets for Bitcoin and other digital currencies. The primary process by which these crimes are identified is trade surveillance. This is the actual monitoring of orders and transactions to detect suspicious patterns of behavior. Historically, regulators have actually outsourced this task to exchanges. So contrary to public perception, regulators have actually never really had the ability to perform comprehensive surveillance of capital markets to identify abuse. Generally, they've outsourced that task to NYSE, the LSE, etc., who monitor their own markets and then report suspicious activity to the regulator. Now, in recent years, over the past 10 years or so, we've seen a new trend of regulators reversing this relationship. And they've done so by developing their own independent surveillance capabilities. Now, for the governance literature, this is the puzzle. Generally, it's predicted that when a regulator outsources some task, such as surveillance, to what's been called a regulatory intermediary, it's very difficult to reverse this relationship. And this is because over time they become more dependent on their expertise, the cost of replicating that task become higher, etc. So it's puzzling that we're seeing multiple securities and energy regulators successfully disempower their intermediaries by developing their own ability to perform trade surveillance. So the paper eventually goes about trying to answer this question, and it really addresses the broader question of when should we expect regulatory agencies to successfully disempower their intermediaries. And my approach is to propose a new hypothesis, and I then substantiate that hypothesis through two case studies. And these case studies both address the SEC's attempts to develop independent trade surveillance capabilities. The data for these cases comes from multiple sources. I performed 60 interviews with regulatory practitioners. I also visited the archives of the New York Stock Exchange and the SEC, and data was also obtained from the SEC through a FOIA request. So the primary argument of the article is essentially that market structure matters, that whenever we're trying to understand whether or not a regulator will be able to disempower an intermediary, this will depend, all else equal, on whether they're dealing with a monopolistic intermediary or multiple competing intermediaries. So in a monopolistic market, I predict the likelihood of success is lower. And this is because there is one dominant intermediary who has very little incentive to sacrifice its exclusive capacity to perform that task. And therefore, they'll actively combat disempowerment, and the likelihood of the regulator being able to take away that task or replicate it will be lower. In contrast, in a competitive market, the various intermediaries will have competitive incentives to actually support the disempowerment attempt. And this can range from wanting to save costs by no longer having to perform that task, to trying to subject competitors to enhanced regulatory oversight by empowering the regulator to be a more powerful oversight body. Now, the paper goes into detail on these various incentives, and it's not an exhaustive list. But the big takeaway is that in a competitive setting, a regulator is more likely to be successful because it would essentially play the intermediaries against one another to support their attempt to overtake the task. So the argument is substantiated through two case studies. And as mentioned, these are both covering the SEC. The first case study, taking place in the late 1970s and early 80s, is what was called the Market Oversight Surveillance System. Essentially, the SEC had seen a rapid rise in abusive activity, and they subsequently were revisiting their own capacity to perform surveillance. And the reports indicate from the archives that they concluded that their own surveillance capabilities were very low, and that they were basically entirely dependent on NYSE, the dominant exchange, who was performing surveillance on their behalf. So the evidence is that NYSE, once it got wind of this proposal, was very concerned. They felt that this was very much a threat to their ability to self-govern, and they subsequently engaged in a lobbying campaign to convince members of Congress to reject funding for the MOS. Eventually, the disempowerment attempt failed. So rather than having MOS come to fruition, the exchanges essentially promised to cooperate more closely to identify cross-market suspicious activity. So as a result, consistent with the hypothesis, in a monopolistic setting, the regulator was unable to disempower its monopolistic regulatory intermediary. The second case study, happening in the 2010s, was the consolidated audit trail. So this was inspired by the flash crash, which was an event in 2010 in which equities markets experienced a very extreme upwards and downwards trend in price. Now, subsequently, it was concluded that part of the problem here was that the SEC and the CFTC really lacked the capacity to monitor this type of trading activity, and it therefore took them a very long time to piece together what exactly had happened. And so as a result, they proposed the CAT, which, exactly like the MOS, would allow them to perform comprehensive trade surveillance across US markets. Now, the structural setting in which this attempt took place was completely different from the late 1970s. So unlike the monopolistic setting of then, it was now a much more competitive environment. So algorithmic trading and other factors had essentially allowed many new trading venues to proliferate, and therefore there was a large number of competing intermediaries. Now, the evidence, which I obtained primarily through interviews with practitioners, is that both stock exchanges and broker-dealers had various incentives to support the creation of the CAT. Now, this isn't primarily because they were super interested in improving SEC oversight capabilities. It was more based in self-interest. So both groups of actors had various reasons, primarily due with competitive interests, to allow the SEC to actually enhance its own oversight capabilities. So, consistent with the hypothesis, the disempowering attempt succeeded, and the SEC has now obtained the independent capacity to perform consolidated surveillance of US markets. So the main implications of the study, the big takeaways. First, there is an empirical discovery. So the data on the MOS project essentially demonstrates that regulatory politics undermine the SEC's attainment of surveillance capabilities. So this raises a question about how things might have been different if this hadn't occurred. If the SEC had succeeded, they may have been in a better position to oversee capital markets, to investigate fraud, and perhaps predict and at least diagnose crises. Additionally, the empirical work on the CAT project, it sheds a new light on a very controversial initiative. The CAT has been a long-standing and somewhat painful project, and it's also been very controversial. And this article provides a lot of new empirical insight on the regulatory politics and the complex concerns at play in this initiative. And finally, the main policy takeaway is that regulators should exercise caution before outsourcing exclusive rulemaking or surveillance powers to monopolistic actors. What the evidence from the CAT and the MOS demonstrates is that regulators' relative power in a competitive setting generally tends to be higher, in the sense that they'll have more flexibility to take back certain outsourced functions. So it's one additional factor to consider when potentially outsourcing some kind of task to a regulatory intermediary. So thank you very much for your interest, and here's my contact information. And thanks again to the editors of Regulation and Governance and the peer reviewers. Thank you.